Well, hey, everyone. Welcome to another week of live, right? I actually go live on the platform, as you guys know, and I record it on YouTube. I upload it on YouTube. So, we're going to talk about the market. We're going to talk about what is to be expected. From this one simple image, we're going to be navigating, how the market will be, what is to be expected, what are the sectors to go on, how do we hedge our portfolios. I think that this is a very interesting time, especially as you guys already know, and it's very crucial to be actually doing this. But you guys know the drill. Before we begin, smash that like button, smash that subscribe button if you haven't, smash that like button if you enjoyed this video, smash that heart, and just stay hashtag live if you're here. And if you're watching this on replay, click hashtag replay so that I know you guys are here. Now, I appreciate, again, I want to thank everyone that has been watching our channel and supporting me. I'm not sure if you guys have been hedging your portfolios. I'm not sure if you guys have been protecting yourselves from downsides, massive drawdowns. How are you going to do? What is your portfolio strategy? We all talked about that. I think this session is really crucial, simply because it's important times right now, right? And I'm going to be sharing my screen. So here I have basically one of the slides that I did from my courses since 2019. And it's so relevant, right? Sector rotation is so important. So I'm just going to enlarge this here. And, it's so important, it's so key, because in this one simple image, it actually tells us how the market will be. And because, markets are always in cycles. This whole cycle is very easy to draw, but it could last 10 years. Now, again, we addressed this before. We have experienced a massive bull run for 12, 13 years now. And right, it's all the way bull. Now there's some bears, there's some bulls, but now it's getting serious, right? Inflation is getting serious. The war accelerates it. Increasing inflation, so here's the cycle. When interest rates are low, obviously everyone's spending, companies are expanding, everyone's borrowing money. There's a huge, stimulation going. But now when inflation is going up, accelerated by the war and, macro events on the supply disruptions and, supply crunches, that's where people have less spending power. So when they have less spending power, especially when interest rates go up, they can't afford to be borrowing stuff and buying more assets. Riskier assets actually go, down the drain, as you guys know. So the key indicator obviously is that corporate profits, how are they going to maintain their margins? Yep. And I was talking to, someone, my friend, who's actually in the working in Unilever, right? He's actually quite a senior role there. He's actually trying to say that Unilever is letting go, 2,000 senior staff because of payroll, right? So imagine when a company has compressing margins, due to asset prices, raw materials and whatnot, that is uncontrollable, they have no choice but to actually be deducting and keeping up their margins by letting people off. Now that's where the cycle comes in. So unemployment is strong because it's at 3.6%. Still, we still need to hear about what's the update on unemployment. But will things get better from here, or will it get worse? Right? Because if we look at the cycle, yield curve, unemployment, eventually it goes back up again, and that is due to companies' profits, right? Companies' profits, if it's going down, they have to actually let go of staff because there's no demand, right? So it's inevitable. It's inevitable that the market will actually go down, because number one, is in a cycle. Number two, people are actually spending less money. They're actually getting cautious, right? Americans are actually getting very, very cautious. To keep up with inflation prices, they're actually saving more money. So that's where, they actually spend less. If they spend less, there's no stimulation. There's no stimulation, there's no demand. There's no demand, there's no corporate profits, right? That's number two. Number three is, with all the inflation actually going up, right, asset prices will still remain up. But so, the question is, should we be investing in commodity inflation related plays? well, eventually that's going to go down as well because a recession is actually painful, right? So when a recession happens, companies will go down because there's no demand anymore. So when there's no demand anymore, what are the companies we should be buying, right? Now, there are necessities when it comes to the products that we consume every day, right? We still need to pump gas, right? We still haven't replaced fossil fuels. We need energy. We still need to eat, right? Staples, defensives. We still need to go to the doctors. We still need to use, water, electricity, so that's utilities. So basically, defensive comes into play, and those are the sectors that will make sense, right? So hear me out. These are the reasons why it's inevitable that the stock will actually go down. But knowing the stock market, understanding the stock market, we should look at cycles and we should look at how the stock market is actually faster than what it is. Now, see, in this simple image, and we talked about this before in our previous lives, right? Ever since I started in this platform and this Facebook platform, I've been preaching this all the way, right? We should get ready for this. And where are we right now? We're market top, bear market. We can't really navigate where's the market top and bear market. Actually, we can, because bear market, see, all the points are starting to line up now, right? We are in bear market mode. S&P 500 not yet, but if we do, then it's going to be one hell of a crazy ride. Nasdaq's on bear market because of interest rates, obviously. So when interest rates go up, commodities go down, right? That's the concept. But energy has been going up, right, due to other forces. So let's try to navigate where we are right now. Yeah, let's try to navigate where we are right now. Nasdaq's on bear market. So if we were to actually put an X on where are we, I would say we are roughly here. Why? The economy is actually on full recovery. Now, GDP was negative 1.4%, right, 2 weeks ago. Is this a starting trend that it will be more negative towards, will it be more? So that's where we look at company profits, right? We look at how well, consumer sentiment, consumer demand, how well is that going? And, actually, it hasn't been a dent, especially on big tech. So it didn't really sort of put up any red flags. But if the country continues to go on negative GDP for 2 more quarters, then obviously it will be an early recession, right? So we had full recovery because unemployment and everything as well. But notice, see, when this is the economy, right? Blue line is the economy. So when we're in full recovery, unemployment is at 3.6%. Now the question is, what's going to happen next year? The market already picks up with this. So again, the market is always faster than the economy, always. During full recovery, right, the market is already selling off. And that's exactly what's happening. Exactly. Now, I wouldn't say this is the bottom. I think we're nowhere near the bottom, simply because we have not reached into recession yet, right? So hear me out. The economy is actually going this way. Again, it's in a cycle. It's probably a 13-year cycle from now. From early recession to market bottom might be 1 more year, because again, the stock market picks up everything early. But if we were to navigate, educated guess on where we are, I would say here, bear market, yep, more room to go down, right? Full recovery, because we're in full recovery. It may, if they don't control the inflation situation and the war continues, then the early recession and full recession will kick in. Now, if we are already here, we can sort of navigate roughly how we want our portfolio strategy to be. Because during these times, what is exactly the type of sectors that we should be investing? What are the type of stocks that we should be investing in, have our hands in, to hedge against our portfolios, right? Number one, energy. So this is in theory, but everything is actually playing out as per what we've been talking about. Energy is accelerated, obviously, from the war and, ban of Russian oil. We got supply crunch, OPEC, all that, controlling all supply, right? The key thing is oil price is going up at 110. Warren Buffett is investing heavily on Chevron, Oxy, and whatnot. Why is he investing? He's investing more than what he has been since last 2 years ago. Why is he more aggressive right now? Because he sees that the stocks that is within his competence has a chance to go up simply because it's controlled by oil prices. So when oil prices go up, it's at 110 per barrel right now, US oil. 110 if the war breaks still continues and when things are starting to get bad, well, what do you think oil prices are going to be? It's still going to be above 120, 130. Now, the key thing about that's why I've been saying I keep on constantly ask, during the our sessions, our Discord group, and Facebook. I've been asking, are you guys hedging your portfolios well, right? Because I took a heavy position in Oxy, not as heavy as I thought it would be. I could go more, but uh, you know, thermal coal related stocks like CIX Console has been flying up like crazy. So what are we doing to hedge our portfolios, right? This is mine. I'm not trying to don't buy. Please don't buy just because I said it. Do your due diligence, build your thesis. Does the question is, do oil stocks still have a huge runway ahead of them? I personally think they do, simply because of what's happening in the situation right now, right? So we got staples, and we're going to look at a few stocks later, right? Consumer defensive and cost conscious stocks, which actually goes up during a bad period, right? We're going to do a little case study on that. And healthcare, which is not really my forte and not really my taste, but these are the stocks that will eventually pick up, and we should be defensive simply because we want to hedge our portfolios, right? So again, if we would navigate where we are probably here. There's a lot of room to go down, and that's where we should be piling on again onto our defensives. Now, finance is on late bear market simply because when interest rates will finally go, boom, as in break out, they have no choice but to lower it down when inflation actually picks up, right? So when inflation actually goes down, they'll follow interest rates to go down further, and when the interest rates go down further, finance stocks will eventually go up simply because there's more expansion right now, right? There's growth. People will borrow more because interest rates are going down. So again, it's a cycle, but we need to constantly keep our drawdowns, our portfolio strategies in check, right? You are a long-term investor. You holding, 8, 10 stocks, 12 stocks, 15 stocks that are all high growth, then expect a 70% drawdown, right? In your whole portfolio. I'm in Discord groups. I'm a coach in Discord groups, and they're all telling me, oh, Coach Warren, 60% down, 70% down. What should I do? Well, consider sector rotation. Consider, right? Because market moves in cycles. We need to hedge our portfolios and protect the drawdowns. But if you can stomach the volatility, then go ahead. I can tell you the reward over risk. Again, 2022 is a year of accumulation, right? 2023 as well. We want to accumulate our stocks that will do well and survive the 1.5 years. The worst, it was sort of like a depression in a way, where the stock market was tanking 1.5 years. If we have funds that can last 1.5 years, we can stomach that and just trade along the way, then great. You're not using your emergency funds, right? That you so-called want to put more cash in so you can survive, then that's great. Wait it out. If you can't, then you need to consider about hedging. This is exactly what we're talking about today, right? So, portfolio management can be another sort of session, but what I'm trying to say here is that these are the type of sectors to consider and trying to navigate where we are in the market right now from one image. This is where we are. So late bear market, then after that, market bottoms. So what do you guys think? Let me know in the chats. What do you guys think the next market bottom will be? 1 year time? 6 months time? Let me know, right? Then we look at finance, technology, cyclicals, because this is where the bottom is. When the market's bottom is always the best time to be going in. So again, it's always a good time to go in right now, provided that your portfolio management allows it. But the key thing here is we need liquidity. We need cash, because in a year's time or 12 months, 12 to 18 months time, when the markets are so-called bottom, you will be begging to go in. You will be begging for the market to drop again to go in. So these times don't occur frequently, right? Again, market is in cycles. Every time there'll be a bear, the bull triumphs. It only takes time. The bull will take time. Stock market will go up. Why? Why will the stock market go up? Why is the S&P 500 going up? Population growth, demand is definitely there. technology is growing companies, right? Inflation is existing. So when inflation exists in, healthy countries, asset prices will go higher, demand will go higher, it will all pick back up. When the market bottoms out, and now I'm not trying to say the market is, at bottom, the market is brutal. Let's put it that way. The market is very brutal. Keep cash, keep liquidity. When the market is bottoming out, you are going to regret and say, if you didn't go in at that time, and we never know when's the market bottom. That's why we use indicators, right? Stochastic, oversold, RSI, whatever. But my point is, if you have not been accumulating the shares that you want to hold in 3 to 5 years out, then you'll be regretting, because the best time to buy is when it's down. So, my own group, my own Discord group, I coach people. People are actually staying away from the market right now, where it's actually time to go in, right? So every time there's a bull market somewhere, right? And this is what we're actually trying to explain. We've got healthcare, utilities, finance, technology, cyclicals during another time, energy, especially. I've been preaching this all the way since February 24th after the war, right? I got in late, but there's still room for upside. So my point is, keep liquidity, keep cash, know what sectors to hedge on, know what sectors to hedge on if you want to, minimize your drawdown of your whole portfolio, because everything makes sense, right? Again, the market is faster than usual, right? Early recession, the market will go down some more. But when we have full recession, that's where the market actually picks up, right? Again, sector rotation. And that's where we need to pile on to our beloved technology stocks, right? Industrials, basic materials, because that's where people start to buy more again. The demand is actually getting huge again. And, demand for property goes up, basic materials will go up. Demand for, any other uses, industrials go up. Technology, again, technology is a everlasting, evergreen, depending on what company, obviously. I would say Google, one of my top conviction plays, right? Google is a no-brainer. Recession or no, they're still going to be doing well. They can literally live off like, dozen lifetimes. It's crazy, right? We need cash resilient stocks. We need good balance sheet stocks. We need strong cash. We need low debt, net cash stocks, right? We need stocks that can actually survive for 2 years if you are investing in non-profitable companies. So the point is, understand sector rotation. We talked about the green sort of sectors, the bull markets, even during down times. And, we will do well. So I'm going to be sharing this actually sort of let's talk about stock prices for a little bit, right? If a recession happens, right? So I've been looking at 08, and this is the comparison of Dollar Tree stock price in relation to the S&P 500. So the orange is the S&P 500, and we got the candles, which is, Dollar Tree. So ignore the fancy sort of indicators, right? What I want to say is basically, I have been looking at stocks to actually hedge on. I haven't made a move in Dollar Tree, which is stupid, because I would have gotten, easily a 50%. But Dollar Tree is the only stock, right, since the beginning of January 2008, when the market is sort of picking up some sort of recession, but the S&P 500 is still, up. It slowly stagnates down. That's when, the whole market's on panic mode and whatever. Dollar Tree is the only company at the moment that I'm seeing. So I'm still digging here. But check out Dollar Tree, guys. Dollar Tree in 2008, Dollar Tree from bottom all the way to 2009, gaining 98% when the S&P 500 is actually down around 40%. See how crazy that is? So we got 98% of Dollar Tree. And if I go from the highs, so-called the highs from the S&P 500, it's actually down 47% when Dollar Tree is actually going up. So, if you think you can't 2x your money in a downturn, right? Think again. Dollar Tree is one of them. So I'm still digging into what company to go in. But Dollar Tree is not exactly a staple, but it's still cheap, right? It's cost conscious. Now, people still have money in the markets, right? All they need to do, they're just pulling up their savings a little bit more to, to survive on high inflation stocks. But Dollar Tree, knowing there's cheap products, right? Cash flows, low debt, these are the companies that will still survive and do well, right? Regardless of the valuation. Now, these are not high growth stocks. I'm not talking about high growth anymore. I'm talking about surviving value stocks that we can potentially thrive on. Now, obviously, 2008 and now is a different scenario, right? So, you want to ask me, can I invest in Dollar Tree now? Well, I'm probably not going to be going in now, but I'm actually giving some statistics and it's just showing what happened, right? So the S&P 500 tanked all the way to 50% and the lows, 53% when Dollar Tree is actually going up. So there are chances that stocks will still go up. It's a matter of what do we do to be digging it. So going back to present, Dollar Tree is actually well, it has gone up since September 2021. So since September 2021, they have been actually going up 100%. That's crazy. So is there still upside? Well, it depends on valuation, right? Now, that's where fundamentals kick in. But I just want to show a little bit on what's going to happen, right? So the S&P 500 is starting to tank. The question is, will Dollar Tree still have any upside? And that comes into, valuation. Yeah. S&P 500 will probably tank some more from the highs, which is, let's go at 30%, which is here. The question is, will Dollar Tree go up? Now let's assess Dollar Tree a little bit. So we're looking at a P of 28, forward P of 18. See, that's the key, right? Forward PE. The margins are obviously slim for this type of business model, but the market cap is 38, right? Sales at 26. So will still continue to grow even during a recession. Can they survive? Yes, because they have practically no debt, right? Will the forward PEs be better? Will earnings growth be better? Yes. If it does, we can track down the historical PEs of a Dollar Tree and assess what is the decent ratio that they deserve during a recession time. Then we might even consider to be adding in during weakness, right? So Dollar Tree has been on a weakness, but they are the only stock that is up, I think, other than energy stocks and what's happening in the market. So yeah, consider Dollar Tree. I've even been looking at, Kroger, Walmart, Costco. They're all actually going down ever since recession time. So recession is brutal, but these are cost-conscious stocks where the downside is actually minimal. It's not as great. So, keep digging, right? Healthcare stocks, pharmaceuticals, they'll all go up. Utilities, these are the stocks that we should be piling on if a recession happens. And a recession is, in my opinion, honest opinion, going to happen already. It's just a matter of time. Now, I could be wrong, right? I could be wrong. But again, it's no harm to be hedging. It's like a no-brainer play because it's no harm hedging onto these plays. The downside is low. All you got is opportunity cost. And if you think you'll be missing out on opportunities, then pile on more and average more and DCA on your, high growth, unprofitable stocks. Go ahead, right? Because your long-term duration is 3 to 5 years out, which is fine. But, these are things to consider, right? These are things to consider. We need to constantly, so let's take a look at CEIX for a moment. This is a stock that I've been preaching, right? And so far so good. But think about it. I've been, preaching the stocks in other Discord groups as well. So, think about it, forward PE of 6, right? It used to be forward PE of 5, right? So what is the PE that this stock deserves? It's very simple, right? Thermal coal ASPs are going up. Even if production gets stagnant, their earnings growth is going to be insane. So you got a PE of 86. They were losing money company. The stock price has been picking that up already. But you're looking at a 4P of 6, which is insane. It's below 10. So what's the upside if they are PA 12, right? There's another 2x upside potentially. So again, price to cash flow is strong, right? 11%. Market cap is only at 2B. It's a small cap stock. Income, sales is 1.3. Now, I'm not looking at PS ratios. I'm looking at definitely forward PE ratios. And if they can survive the downturn. So here's the trend of these type of companies, right? Like Oxy, like ExxonMobil, they're getting better ROIC. They're reinvesting back into the company, paying off debt, creating value for shareholders, increasing average sales price, improving margins. This year and next year, in my opinion, they'll do well. So this, before the downturn, in my opinion, this is where we need to be piling on to, these type of stocks, right? Are we investing in hedging our heavy tech, tech stocks, right? So this is something to consider for sure. So yeah, this is it. We talked about the market. We talked about, inflation, recession coming in. We talked about sector rotation, which is key. All we need is a simple image to determine our portfolio strategy. what's going to happen, where are we navigating, where are we at right now. We might even be on top, right? The market bottom might be 1 year from now, right? Which is brutal, but as long as we can ride out the wave. So here's our portfolio strategy, right? Here at Academy. So again, we keep a good portfolio allocation on long-term stocks, and this is comprising of our Teslas, our LACs, our Catals, our EV value chain beneficiary stocks, right? We got battery miners and whatever. Google's, right? These are the stocks that, so there are 2 to 3 stocks that we intend to actually just DCA on, dollar cost average, regardless of any bear market or market time. So regardless of our NAV, our portfolio NAV, we're just going to be piling on more. So how do we pile on more? From our side hustles, from our work, from our savings. We're going to pile on more regardless every month or every 2 months. So those are some stocks, right? So I'm talking about portfolio strategy right now. Those are 2 to 3 stocks. Identify them. Okay. Then we have long-term stocks. Now these are our, fintech, growth, tech, unprofitable stocks. Keep a decent allocation on them because they will be hammered even more if we navigate that the bottom of the market is not here yet. So these are the stocks that we should be mindful of, right? That's the 70%. The 20 to 30%, because the equity ratio is actually more. So the 20 to 30% is on the short-term stocks that we intend to just hit and run, right? One night stand on. We don't intend to marry any stocks. And that's where, well, it could be big swings, right? It could be 6-month swing, a 1 year swing, a 1.5 year swing, or, where I like it, 2-week swing, right? One night stand or 2-week stand, whatever you want to call it. I don't want to marry on these stocks. I just want to be buying them, selling them based on thematics. And, the profits that I get, either I hold it on cash and buying defensives, or I pile on to the DCA stocks that I can have, right? Because my income versus my equity ratio, my portfolio it doesn't balance out anymore, right? A year, someone can earn, 50K, 100K, 200K. It's still not be enough to raise enough cash to make a decent cash position percentage in your overall portfolio, simply because the equity, I've been buying stocks since, 5 years ago, 7 years ago. So those stocks have been actually going up. I've been holding. So the cash amount raised is actually not enough. So what do? I need the portfolio to be liquid enough to be going on in and out trades. So this is our portfolio strategy, right? That's the benefit of trading. That's the benefit of reading on thematics and just digging in, right? So recently the war happened, we went into metal stocks, right? Fertilizer stocks, energy especially, right? So what are the stocks that we went in? Car, Console, Oxy, IPI. These are the stocks that we've been doing. Alcoa, right? Metals, they've been on the sell-off right now, CLF, whatever. So the point is, what is your portfolio strategy, right? Are you a 30-70 guy? Are you 20-80 guy? Are you full 100%, which is fine, but there's no harm raising cash. There's no harm identifying how many cash percentage you can raise a month so that you can be 30% in 6 months. If you are 30% in 6 months, what are you going to do? Are you going to keep cash and hold all the way? Or are you going to DCA, right? Not really recommended, but okay. Or are you going to be, well, regardless, it depends on your portfolio strategy again, right? Or are you going to be going, developing a short-term sort of thematic play and reading trends? That's riskier. But, if you're full-time, if you have dedicated enough time to dig into it, then, that's fine. Again, like us on our YouTube, subscribe to our YouTube just to be searching out more and see what we've been actually preaching. Follow us in all our channels, right? Instagram, Facebook, whatever. So yeah, these are the plays that we have. We have a lot of options that we can deploy. There's plenty of opportunities in the market. You can just raise, try to get like quick 10%. There's no problem, because or even have pullbacks. So NASDAQ, the stock market doesn't go in one way, right? Stock market just goes up, goes down, it goes up, it goes down. The only problem is it's a slow staircase down, and that's possible. But during these upsides, right? And we can learn about indicators and whatnot. That's where we actually pile on some of the smaller allocation that we have, then try to be profiting off that that wave up before starting off and raising cash, right? My job is to allocate capital. I'm a fund manager. I manage family office. I manage my own funds. So my job is to protect from drawdowns, and this is the way, right? I hardly keep 10% cash, or I hardly keep 30% cash, to be frank, because my cash is actually deployed and trying to make it work for us, right? So again, we talked about market, possible sectors to go into, Dollar Tree, the stocks that I'm hedging, where I follow earnings, right? Car, Avis Group, we talked about that. So hope you guys got some value out of this. Don't forget to smash that subscribe button, smash that like button, and I'll see you again next week. Thanks, guys.